Good morning, everybody, and welcome. My name is Anthony Kazazis, and I am the director of the NYC Network Group, as well as the NYC Real Estate Expo. And I want to thank you all for everybody that registered for today's webinar, The Untapped Potential of Private Money Lending. Our sponsor today is LendingOne. Headquartered in Boca Raton, Florida, LendingOne is a direct private lender that was founded for investors by investors. The combination of their user-friendly technology and team of dedicated real estate professionals has made for a better financing experience for borrowers across the country. LendingOne helps finance real estate investors with the capital that they need to fix and flip and rental properties portfolios. The virtual seminar for finance brokers and loan officers. Our guest speakers today are Michael Boggiano, Director of the Multifamily Origination team of LendingOne, and Mark Hurley, Wholesale Manager of LendingOne. Here today, of course, we have Michael Boggiano, Director of the Multifamily Origination. Mike has over 25 years of experience in originating commercial real estate loans, including agency, CMBS, small balance, and bridge. As a director of the multifamily origination for LendingOne, he is responsible for the overall production of multifamily bridge loans, ranging from 1 million to 20 million. In addition, Michael also originates SFR, single-family residential portfolio loans. Mark Hurley, wholesale manager. Mark has over 18 years of experience in the real estate industry, from brokering, selling, renting, spec building, asset managing, and lending. He brings both real-life experience and knowledge to LendingOne. As the wholesale manager for LendingOne, he is responsible for the overall production of the broker channel. He assists clients by providing solutions-based lending for bridge, rental portfolio, and new construction loans. Guys, welcome. Guys, before we actually get started, Michael, let's start off with you and tell us, how long have you been with LendingOne and what made you go to LendingOne to work?
Anthony, good morning. Thank you for putting this on for us. We greatly appreciate that. I joined LendingOne about 18 months ago. Primary reason I joined was that the technology that they offer, both on the platform and to the brokers, it's unmatched in the industry. So they're a cutting edge lender in the marketplace today. They're ahead of the curve in terms of employing technology. And I think that's, the wave of the future. We're going to see more technology being incorporated into lenders' platforms on a go-forward basis.
Mark?
Hi, good morning. Again, thank you, Anthony, and good morning to everyone. I've been with the company since the summer of 2016. I believe I was like the 5th salesperson. So I've been with the company since its infant stage. What brought me to this sector is that there was a paradigm shift from asset manager, from the REO shift, that I wanted to go back into the lending aspect because I was doing retail during the boom. So I got into the private lending sector to kind of overall broaden my aspect of the industry itself. I second what Michael says, our technology and the easiness and like the deal flow process is what really drew me into the company. Initially, we were a very small company. We had about 10 employees and we've now grown to over 70. So to be a part of a company on the infancy stage to almost an industry leader has been really exciting and expanded my growth with the company.
Oh, that's great. Thanks, guys. Without further ado, I'm going to ask you guys to start your presentation.
Excellent. Well, as you can see, this is our home screen, the untapped potential of private money lending. Michael and I are going to give you an overall view. I'll start first doing a brief introduction to really our bread and butter, which is bridge lending. We call bridge short-term fix and flip. Rental, we'll discuss purchases, refinance portfolios, and then new construction, ground up spec builds. Michael will then introduce into our multifamily sector and learn a little bit more. So we're going to give you a four-course meal, right, into what we do here. So we'll start. As of course, you know, Michael and myself, these are our pretty mugs and our faces. Our topics for today, we're going to go over a little bit of market insight, the ins and outs of our fix and flip. We do offer a true 30-year fixed option. It's a 30-year amortization rate. I think we're one of the very few in our sector to offer it, and we're very proud of it. Construction loans for investors. We've been getting a lot of inquiries about new construction spec builds, as the bridge loans are a little bit tough due to inventory restrictions right now. Going over our customized technology, the overall lending process, most importantly to you guys, the broker commission structures, how much money can you make, and then our quick and reliable funding. So our first slide, as everyone knows, is that the fix and flip trends, especially during this pandemic, have taken a little bit of a snag due to restrictions with forbearances, and the market right now in the retail sector is red hot. So it makes it a little bit tougher for our investors to find fix and flip properties. However, many are. They just have to go back to more grassroots marketing, mailers, things of that nature. You'll see some overall trends for the third quarter of 2020. There's about 57,000 single-family homes and condos that were flipped in the US, so there are still opportunities. That overall represented about 5% of the home sales shares. That goes a little bit more about Q2's and Q3's numbers to give you an overall view of how we're trending. We do anticipate an increase once some of these restrictions and forbearances are released and there's more normalcy to this market. As you know, people are being vaccinated. So hopefully Q3, Q4, we'll see a little bit more of an upswing in that sector. And of course, most importantly, our investors are making a lot of profit because of the high prices of the home selling. Market trends. So here we're just giving an overall picture. Michael and I have been seeing a huge increase in the Midwest right now. Northeast is a little bit tighter because of restrictions. So states that do have more open restrictions than others are seeing an increase of opportunities and more real estate transactions. To the left of the screen, you'll see some metros with the biggest increases, also some profit margin increases. And then lastly, the investors are selling for at least double their purchase price in 14 metro markets. We do kind of stress at Jonas, we do want our borrowers to make money. So we do look at a deal gross margin. We try to make that at least a double digit. We do have flexibility based upon the tightness of certain sectors out west, the Northeast, and the investors' experience. But overall, we want the clients to be successful and to have a really good experience. Now let's look at this with financing and non-financing options. What we're seeing is that still cash is king. It's owned overall about 57% of our sector, with financing coming in about 43% of that sector. But what we find is that many times people are able to make an all-price offer with, getting an addendum to do private money. So our sector, it's not really a hard money lender. We're a direct private lender. We're kind of like an intermediary between a bank and a private money lender. We have better rates than hard money. We close much quicker than a bank. But we do give the investor that comfort that it's kind of like a cash offer with appraisal contingency. Then lastly, you'll see FHA buyers. That's really not our sector. What you find more so is that it's more of a conventional market right now for financing. So we're going to go over some brief fix and flip bridge loan data points. So what is it? We offer a fixed and flip loan. So if somebody's going to purchase it, fix it up, and then sell it for retail value, you can do so. We also offer the ability to do a fix and hold. So many times right now, we're finding that people want to add to their portfolios, but to buy a market property may not make sense because of debt service coverage ratios or just high price points. But the investor may find a distressed property. So we offer our bridge to rent loan, where we'll finance both the purchase and the repair cost. Then we can refinance into either a 5/1 ARM option or a true 30-year fix. Going back to the fix and flip, it's a 12-month interest-only loan, paying only on monies borrowed. The construction budget is held in escrow. They do not incur interest on undrawn construction funds. So initially, they're only paying interest on the monies borrowed for the purchase price. This is a huge cost savings and very rare in our sector. We're one of the very few that do not charge interest on the entire construction amount, only when draws are taken out. Our loan amounts, we do have a little bit of flexibility. Under 100,000, it's going to be based upon the metro area and the investor's experience, but ideally, 100K net, that's combined of purchase and repair costs. to over $2+ million. How much over $2+ million? Again, it's going to depend upon the metro area, the investor's ease and experience in a higher end price point, but we can easily look at something for you guys. Minimum purchase prices on a acquisition on a bridge loan, I like to try to keep it at 80,000. We do have some flexibility, again, going under based upon the experience in the metro area. Minimum credit scores, try to keep it at a 650. 680 is our sweet spot. Under 680, we can go below to 650. There may be some leverage restrictions, but we can get it done for you guys. Most importantly, loan to cost, it's gonna be, that's a blended of 90% leverage based upon the experience. That's what we see on average. Closing timeframes, we do have the ability to close within 10 business days from a completed application and underwriting submission. Heavy renovation. If you have somebody who's buying a property for $100,000 and they're going to put $200,000 of work into it, can we do it? Absolutely, we can. We'll do that. What's called our heavy reno. There's a slight LTV restriction, about 5%, but we do not discourage somebody taking advantage of a distressed property, doing a huge value add to get a huge return. We're very experienced and well-versed in that area. And then, of course, the last, and I've already touched upon it, no interest charge on undrawn rehab funds. Very important that the investor saves as much money initially up front, and they're not going to be, shelling out cash on unused funds.
Hey, Mark, let's see, we got a first question.
Okay.
We're a national lender. Are there states that we don't lend in, is the question.
That's a great question, Michael. We do lend in over 45 states. So that's almost the entire US. There are 5 states we do not lend in. Those are going to be North and South Dakota. That would be Alaska, Utah, and Nevada. Now we are looking into Nevada. That could probably be a state that we're going to look into hopefully this year by, maybe sometime next year, but those are the 5 states we do not lend in. Everywhere else we can do. I get this question, we get a lot of questions about our construction draw process. Once a client does have repairs, the main thing that I want to kind of emphasize is that we just don't front cost up front, because we don't want a contractor running off a job site with $20,000 of somebody's construction money. So it's kind of like a refund process, if you will, or reimbursement. Work is to be completed. Typically about $10,000 of funds or monies completed. They come in for a draw. We then send an inspector out for that. So the borrower submits a request, an inspector schedules the inspection directly with the client, and the goal is about a 2-day turn. Many times it can be same day, but it depends upon availability. Once an inspector goes to the property, they give us back the report internally. We review it. And then we look at it and say, okay, this report is approved, or, hey, can you clarify some things? I know the investor required 40,000, you only put 20,000. Is there a discrepancy for the 20? We ask for a little explanation. And sometimes they say, oh, you know what, let me go back out, or it's justified, only $20,000 of work was done. We then wire those funds directly to the client's account, your client's account, so they can pay their subcontractors. There is a small fee for that. That's why you see funds coming out about every $10,000. It's typically about $150 per inspection process. Depending upon the scope of work being done, you on average see 3, maybe 4, and that's assuming about an average $50K budget. Higher end budgets, you may have a little bit less because more work is being done. It all depends upon the availability of what your client is experiencing with their subs. And of course, our goal is to fund everything within 72 hours. I can attest that many times it's same day, within 24 hours, as soon as we get it, our dedicated construction draw person will send out the wire once everything has been cleared. This is going to give you a little insight of some of our recently closed fix and flip deals. I'll start from left to right. On left, we have a New Jersey property. I believe that was a SFR. Yep. Total loan amount. So that was the amount of monies we lent on both the purchase and the repair cost. So in this example, we lent a total of almost $967,000. If this person was experienced, we were going to give them up to 90% of their blended loan to cost, capped at about maybe 75% of the after repair value. whatever the appraisal came into. To the right, you'll see a similar property like in the state of Florida. As you can see, it's got blue skies and green grass. That loan amount totaled about $755,000. So we are very comfortable with higher end loan amounts. We're also very comfortable with lower end amounts. So we don't try to disparage. However you're getting your clients, shoot it over to us for a scenario run. If you have any questions, we try to stay as lenient as possible to help you guys make some deals for yourselves.
Hey, Mark, there's another question. Sorry to interrupt you. Anthony, go ahead. I see another
Yeah, that's
question.
okay.
popped in.
Yeah, I just didn't want you to get to the next slide. I was
Sure.
just waiting for you to complete yourself. Will you lend to the first-time flippers, and do you charge extra for the lack of experience?
That's a great question. Okay. So what do we look at for experience? We do want somebody to have some experience. Not a lot, but just a little. So what is a little? At least one sold flip within the last 2 years or 2 rental properties owned. So the question is, well, how do you treat rentals? Well, for every 2 rental properties, we will account that as 1 sold flip. So you don't necessarily need to be a fix and flipper. You can do an investor that has 4 addresses. They own 4 addresses. We'll count that as 2 sold flips. Our leverages are based on a tier system, like 1 to 2, 3 to 7, 8 to 14, and so on and so forth. So we try to make that available and kind of do a broad stroke to help people out.
Thank you, Mark.
Our rental property trend. So that kind of concluded a little bit of our bridge loans, our purchase and repair loans. We also have the ability to refinance into a rental. We're seeing a huge increase in our rental productivity, especially the refinances with the refinance boom going on. Our rental property market trends, as you can see, there's some apartment rental trends as well as some single family home rental trends that are occurring in the US. I would say that overall, we do have the ability to go up to 80% of the purchase price lending on a purchase, up to 80% on a rate and term. A rate and term for us is that you take the existing loan amount divided by the appraised value. For example, an $80,000 loan balance to $100,000 market value is an 80% loan to value. We'll do that on a rate and term. We can also offer up to 75% on a cash out. So that's a very big for us. I think everybody in the industry is either at 70 or 75, but our rates are going to be in the 5 ranges for those. So we're going to go into our 30-year amortization loans. Again, this is a true 30-year fix. So it's a 30-year fix, 30-year AM loan. Kind of going from left to right again, purchase, rate and term refinances, cash out refinances, and then portfolios. So huge opportunity for portfolios. We do a minimum of 3 properties. We try to keep the net loan amount about $500,000. We do again have leeway. We can go as low as $400,000 on a net loan amount. We do like to see a collective market value anywhere between $600,000 to $700,000. Kind of keep that at a minimum. Credit score wise, what qualifies for top tier? Well, for us, you have a 740 plus FICO, we'll go up to 80% on a purchase and a rate and term. We'll go up to 75% on a cash out for a 720 plus. But what if my client has a 680 to a 699? No problem. We'll go 65 on a cash out, 70 on a rate and term or a purchase. And then the middle tier, 700 to 719 is a 5% bump on both of those figures. We offer a 5-1 ARM option. Not seeing a huge increase of a 5-1 option because our rate for a 30-year fix is so competitive to the 5-1. It's about 10 to 15 bips of an increase. So a lot of clients are just doing a straight 30-year fix rate with us. Great question we get a lot. Any limited number of properties or loan? No, we don't restrict it that you can't have, any more than 10 loans. We have many clients that have 10 plus loans out with us. In those instances, we look at the overall performance of the loan. There's no cash in hand limits on a cash out. So if you're going to cash out and get $1 million cash, that's fine with us as long as, the portfolio is performing. We look at the debt service ratios and the appraisals and everything is taken care of. No balloon. So it's a full amortization. Rates based upon credit and LTV. It's not a DTI loan. real important. It's not debt to income. It's a debt service ratio. So we look at the cash flow of the property. We take the monthly rents, either whatever the lower the twos are from the market rents or the lease amount on the lease, divided by the monthly principal, interest, taxes, and insurance. So that's our ratio for qualification. We do have the ability to go as low as a 1 on that debt service ratio. The loans have a prepayment penalty. It's a 5-year step down. However, we do have the ability to offer a buy down on that, a 3, a 2, or a 1-year buy down. We also have the ability to do a rate buy down for an increase on points. So there's a lot of ways that we can, do add-ons. If you also want to make a YSP, we have a YSP option as well. So, we're going to try to help you guys and make the most amount of money as possible on the YSP. And then closing time frame. Ideally, we'd like to close in a 20-day time period. Right now, we're seeing a little bit of delay from appraisers because of their availability and their demand. So that 20 days, probably 22 to 24 days, depending upon where in the US. But we try to keep it as 20 days as much as we possibly can.
Mark, here's another question that just popped in. Are these loans available for 5+ units for multifamily? The answer there is no. This product is only available for single family or 2 to 4 unit properties.
That is correct, Michael. Yep.
So just to clarify that.
Yeah. So we're capped at 4 units it could be on a parcel, 4 units, or a quadplex. You can mix and match on a portfolio loan. But to Michael's point, that if it's one parcel, like I had a question today, I have one parcel, it has 2 properties, it's a single family, and then 4 units. Well, that's a total of 5 units that would be qualified for a commercial loan. Right now, we don't have that ability. Hopefully in the future, we will. Looking at some recently closed rental deals, just to get an overall view. To the left, you'll see a California that is a condo. Yes, we can do condos. One caveat is that the building the unit has to be warrantable. So we do have a questionnaire that we'll provide. It's about 6 pages. It's a very simple, simplistic questionnaire. And there are some documents that we need from the association. And then to the right, you'll see a single family SFR in Michigan on a purchase. So again, single family, townhomes, condos, 2 to 4 families. That's our sweet spot on the rental. All right, Michael, why get into multifamily lending? Why don't you tell us a little bit?
Multifamily lending, great business, growing business. Volume in 2020 was down to $288 billion, and that was a result primarily of the pandemic. A lot of refi business that occurred in 2020, but the acquisition business was off about 33%, 34% from the year prior. The NBA and other financial organizations are projecting an increase both in acquisitions and that the refinance boom will continue. Primarily, who finances these transactions are the agencies, both Fannie and Freddie. They have caps this year of $70 billion a piece. And if you look at HUD provided close to $18 billion in financing last year. And then you also have life insurance companies, banks, and private lenders that also provide long-term financing to this market. And it's a great way to increase wealth as an investor. You get the year-over-year appreciation of the asset, and you get some tax benefits such as depreciation that can offset your income over the years. So LendingOne, we offer only a bridge loan product. We do not offer permanent financing. So if you have a borrower that is in need of a bridge, either acquisition or potentially refinance, that it is a transactional transaction where the borrower needs to go from point A to either stabilize the property, maybe need to season it a little bit. But that's the definition of a bridge loan. It's taking you from point A to point B in order to get permanent financing in the near future. So we will finance anywhere from 5+ units up to 350 units. The caveat there is that we look for a minimum per door value of $50,000 per door. We have some flexibility there to drop a little bit below that, but if we're getting into the $10,000 to $15,000 a door acquisition costs, those transactions will not be eligible. It basically eliminates the rural locations and properties that are really in distressed areas. So we try to avoid those areas. Loan amounts range from $1 million to $20 million. We will finance up to 80% of the purchase price and 100% of the repairs. And included in that would be an interest reserve. We can max out at 80% loan to cost, which is a combination again of the acquisition price, the CapEx required, and the interest reserve. We do have a back end test on our transactions. We like to be anywhere between 70 and 75% as repaired value or as stabilized value. If it's a heavier lift in terms of capital expenditures into the property, we probably will drop below that to 65% because, as Mark explained, we like to see our borrowers have a gross margin in their transactions. And if they're spending a lot of money on CapEx, they should be getting a return on that CapEx in terms of increasing the values. Our loan programs are fixed rates. We start at 5.99% on a fixed rate basis. It's interest only payments. We do not have any COVID reserves like some of our other competition or the agencies right now. We do offer anywhere between a 12 to 36 month term. Normally it's 12 to 24 months with a 6-month extension available. But most of our borrowers are in and out of our loans in 12 to 18 months. They want to get the repairs done as quickly as possible, stabilize the asset, and either sell it or refinance into agency financing, which is the rates there follow suit with the residential. They're at historic lows. So they're refinancing from, call it 6-7% interest only rates into 3 to 4% fixed rates on the agency side. A little difference between the single family and the multifamily. We do require a 650 minimum credit score. It does not affect the pricing. It's just we will underwrite the transaction. The sponsor, again, we're doing non-recourse loans, so the sponsor is secondary. Basically, we look to the transaction to support the loan. We can close in as little as 20 business days, which is 30 calendar days, start to finish. We just closed the deal last month that we signed up on January 6th, and it closed in the first week of February. It was full 28 business days, start to finish. We had a very, very responsive borrower who got us all the documents, and we were able to get our third-party reports turned in 2 to 3 weeks. We completed the underwriting. We met the borrower's deadline in the purchase agreement. The seller was not willing to extend them because they had 2 cash borrowers right behind them. If our borrower was not able to achieve financing, we got them closed. We're moving on to another transaction with them because of our ability to close in a timely fashion. And as this last point here on the program is, there's no interest on undrawn rehab funds. Same as the residential side, you only pay for what's been advanced. So you can have $1 million worth of CapEx funds. You don't start paying on them until you actually draw upon them. So this is one of our recently closed transactions. It was a refinance of a fractured condominium sellout transaction. Borrower came to us. They were about 90% complete with their renovations. We provided funding for the remaining of the CapEx that was required to finish out the individual units. We provided an interest reserve. There was individual release prices provided for each of these units. And it was an 18-month term. Borrower is performing in this environment, even with the COVID. We expect them to pay off this loan within the next 6 months. But we have flexibility in terms of the property types that we look at. We can do, as this one was a fractured condominium for sale, we'll do a fractured condominium for rent, provided that the borrower has more than 75% of the individual units.
Okay, so now we're going to talk about a little bit of our single family portfolio loans, which is really taking shape in this market.
So we provide financing on a non-recourse basis from 1 million to 25 million. Mark previously referenced, 3 properties with a minimum loan amount of 500,000. That is on a recourse basis. So we have the flexibility to offer both recourse and non-recourse to borrowers. It just depends on the loan amount. If it's below $1 million, it's going to be a recourse loan. If it's above $1 million, the borrower has an option of going both recourse to non-recourse, I should say, to a maximum of a $3 million loan amount. Anything above $3 million will be non-recourse to the borrower. So we provide financing both for purchase, rate and term refinance, and cash outs. We've done hybrid transactions where a borrower will come to us with an existing portfolio and they want to cash out to acquire another property. We will provide that financing for them. It's a hybrid closing. We finance them, and then typically it's a same day closing, both on the refi and then also on their acquisitions. We can go up to 75% loan to value on these transactions. The only caveat there is that we do underwrite to a debt service coverage ratio. Normally it's 1.2 on the non-recourse and a 1.3 on the recourse. It's just different underwriting in terms of the debt service coverage ratio. I will tell you the recourse, it's a lighter underwrite. That's why the ratio is higher at 1.3 versus the 1.2 on the non-recourse. The non-recourse underwrite is more like a commercial underwrite, whereas the recourse is more of a residential underwrite. So we do offer 30-year terms on the transactions, 30-year amortizing terms. On the recourse, it's either 5-year or 30-year fixed. And then on the non-recourse, we offer both 5, 7, and 10-year terms on a 30-year amortization. We do provide an interest-only option. Obviously, if it's an interest-only, it has no amortization. It has either a 5, 7, or 10-year term for the transaction. Competitive rates and terms. Our rates on a non-recourse basis start at in the low 4s. I quoted a transaction. It was a $25 million transaction. 65% LTV, interest only. The start rate there was 4.4, and that 4.4 was on a 10-year term. Non-recourse, very competitive in terms of the marketplace. And again, we do offer both non-recourse and recourse financing options. And here's a couple of properties that we were able to, a couple of portfolios that we recently financed. These were done in the month of December. The first one was in Ohio. The loan amount was just a little bit above $2.1 million. And to the point I made earlier, this was a refinance to provide the sponsors with cash out to acquire more properties. So they were growing their portfolio. They put this one into a separate portfolio, and they were going to acquire more properties and have a second portfolio for financing.
Now we're going to talk a little bit about our new construction data. What we've seen is a lot of investors are now doing acquisitions of land, or they hold land, or there's a structure that can be demolished, and they're going to do a new build. So we're seeing a lot of that because on the bridge loan, the fix and flip inventory is very tight. So they're finding other opportunities and other means of making profit. So everybody knows right now, new construction is red hot. Labor costs have kind of skyrocketed. Or I should say labor costs as well as materials have skyrocketed. Laborers have kind of like been shorted a little bit because of everything that's going on, but they're still doing new housing starts. As you can see in December, to the left, building permits over 1.7 million, housing starts almost identical, housing completions about 1.4. I mean, as you can see from completions, the new residential constructions on the right-hand side, the charts are still moving. So I know we're in Florida right now. It's a 12-month hold. If you go into a Lennar or a GL community right now, and you sign on the dotted line, it's a 12-month build-out process. Ideally, it used to be about an 8-month process, but because of the demand, they're selling out, especially from migrations from the Northeast and out West. So let's talk a little bit about the new construction bridge loan program. How does this all work? You actually have somebody who owns raw land. We prefer that it be built ready, meaning that it's been cleared. They may have some plans in place. Ideal scenario is that maybe those plans have already been approved by the city or municipality, being stamped. But we were kind of looking at land that has been cleared, that's built ready, not really raw land. So let's dive a little bit into that. What can we do? Well, we can lend up to 85% of the blended loan to cost. That means of both the land and the construction. The loan amounts, minimum blended $250,000 up to $5 million. That's a 12-month to 24-month interest-only term, so 1 to 2 years. We do have an IR requirement. It's a 12-month IR. So when we do our calculations, we will put that into pricing. Many times what we're doing a lot of is a refinance. So somebody comes to you, they're an active developer, they bought a piece of property months ago, it's been demolished, it's built ready, they have stamped approved plans, they need to refinance out of that hard money loan or another loan that they have through however means, refinance out of that, and then finance the construction costs. So we do a lot of those transactions. It's called a bridge refinance of a new construction. And then many times at the very end, if they have enough equity, that 12-month reserve is taken out of the cash out. And ideally, they have a little bit of cash in their pocket. So it's almost like a very bare minimum. Many times, no cash out of pocket. In those few instances where maybe the construction costs are 200 or 300% of the land acquisition, you may have, in those cases, some small cash out or monies to settle amounts, but we'll review everything with you guys. We even have an amortization schedule for that IR to not confuse you. We'll share that with you, how it's broken down to help explain to your client of this is how the lender at LendingOne will perform and do a 12-month IR. What can we do? Well, we can do redevelopments. We can look at some conversions and condos. Ideally, we like to have SFR, single family residential new builds, townhomes, and then multifamily. I think, Mike, we're going to look into that. I don't know if it's yet available on a multifamily.
That's probably a second quarter, third quarter initiative on the multifamily ground up construction. But since you did mention single family rental, we will entertain build to rent communities as part of the new construction bridge loan product.
Excellent. That's a very good point. Spec development. Spec development goes without saying that it's built to spec. It's not a primary residence. It's being built and sold to an end user. Closing time frame, just like with our rental, it's about 20 days. It takes a little bit longer because of feasibility studies that are needed. There's a little bit more reporting being done from the appraiser. We do review the construction budget to make sure that it's within scope. We do not want to have a deal where the budget may have been miscalculated and the person's coming back to you and saying, hey, I shorted myself 50 grand. I need it. What can I do? Well, we can't really refinance out of that loan that we just closed. So we have a second set of eyes, review that report, somebody who's experienced with feasibilities that says, yes, this budget is in with line. If it's not, what they'll do is they'll make a recommendation for an increase of cost. And we share that with you to tell the borrower, we know you put 150,000 for repairs. It came back, it needs an additional 50 because of material costs. Please increase the budget an additional 250,000 to 200,000. On the new construction, they do incur a little bit. I think the last slide may not be completely accurate. There is money that you do incur interest on that construction. It's during a formula that we will share with you. Initially, the first 2 months, there's really not an interest on that construction cost. There will be a slight as it does increase, and we can share that with you guys. Okay, so how does this all work? Like, what do? You have a deal. Well, we have a Broker Connect portal, right? I have access to it. You will have access to it. You'll go into that broker portal for two main reasons: to do a price quote on a bridge or a rental, as well as a deal submission. So, you don't have to look at a matrix and kind of like put your fingers together. Where is this going to meet? We give you the data that you need. The number of properties the person owns. If this is a rental, how many properties do they own? What's their credit score? What's the purchase price? Rents, taxes, insurance. Voila. It's going to tell you this is what you can go up to. Here's the rate. It even breaks down the P&I payment. So if you ever have a question, you can call me up. You'll say, hey, I just tried the portal. It spit this out. What's the reason? Well, it could be purchase price. It could be repair. It could be credit score. So there could be real life scenarios or cases that we can review, but you will have that ability to give you the confidence that when you're looking at it, it's spitting out the most accurate rate, and you don't have to stare at a data sheet or tape and kind of like figure it out yourselves. That's also true for the bridge loan program on the fix and flip. We'll put the purchase price, the repair budget, the number of deals done, and it's going to tell you they can go up to 80% of purchase, 100% of repairs, or 85% of purchase and 100% of repairs, capped at whatever the ARV cap would be at. So this in itself, the application for the borrower takes, there's about 5 to 6 tabs. It's just going to ask for basic information. Tell us a little bit about the deal. Like, what's the address, the purchase price, the repair budget? How much is it going to be worth when it's all said and done? Where does the borrower live? What's their date of birth, their social? Very simplistic things that are on the 1003. And then tell us a little bit about their history. How experienced are they? How many rental properties do they own? Finding that information out up front is vital to the deal, because it's going to give you the ability to quote the most accurate terms up front. So, if you're kind of just guessing and say, well, give me a broad stroke, we'll do that. I'll give you a broad stroke, as high as 10 and as low as 7.5. But without really kind of diving into the client's like experience level and what they're trying to accomplish, that broad stroke may not win the deal. So we come back and say, hey, can you tell us a little bit more about the experience? We're not trying to pry or take the client for ourselves. We're just trying to help and to assist by giving you the most accurate upfront information upfront. So if there is a counter that they maybe shocked you, we can go back and say, okay, we kind of know who they went to and what the leverage and what that really means. Maybe they didn't tell them the full story, right? Because we don't want to have anybody thinking they're going to get A+++ rates when they just have done one deal, right? It's not fair for you. It's a time waster, and it's not fair to the person. So we try to give you the most accurate update information as possible. All that stuff being said, it's just like a 1003. You have the ability to do a doc upload directly to the portal. If you're having troubles, I don't take offense. Send it to me. I'll upload it for you. I've been doing this a long time. It takes me a few minutes. But it's the easiness. You have the ability, if it's a client who doesn't want to share information, you can send them a hyperlink. They can complete the application. They can also upload the docs, especially when it comes to a tax return on a bridge loan. That's the only time a tax return is needed, is on a bridge, fix and flip. They can upload that directly. They don't want to email it. We understand that. Your Python track line, it's going to give you update track line of your deal process. You also have the ability in real time to communicate with us directly, as well as a loan processor in a note system. So you can type in a note, hey, I need an update on this. Can you update me on the appraisal? Can you update me of what docs are still needed? So how this all works is that you go into your portal, you complete an application. I'm going to say it's under 15 minutes. It takes you 10 minutes. I review it in my CRM. I'll call you up. I'll just review the numbers with you. If the application has been complete in full, I can generate and send you off a quote immediately. Or I can call you and say, hey, I just have a couple of quick questions. How many points would you like? Because our system, sometimes it will just generate our points. So I can call you, you can say, hey, I want to make this many points. Can you do this? Can you do that? And then I'll adjust it in real time and send it right over to you. Once that deal has been submitted and it's in underwriting, you're going to see it in a pipeline tracking. So you can always track the progress of it. The notes, of course, very vital. You can speak directly to the loan processor. So I'm going to be your eyes and ears, if you will. And then we have a loan processor who will get the file from point A to point B, point A being from submission, point B being the closing. So they'll work directly with the title company, they'll order title, they'll follow up with the insurance request, they'll follow up with you directly regarding any and outstanding conditions still needed to clear the file. So we try to make this where you have somebody working for you that you don't have to hire. If you don't have an external loan processor, don't worry. We'll have that ready for you. And then of course, we just went over the quick pricing model for bridge and rental. Now, how does a quick pricing screen look? I kind of touched on this a little bit, going from left to right. Very easily done. You just have to get very basic information. So if you're at a meetup or somebody calls in, it's just taking very basic info. Tell me a little bit about your real estate history. How many deals have you done in the last 2 years? Okay, great. Do you happen to own any rental properties? All right. How many addresses? Very key. We get that back and forth between doors and addresses. So we ask for an address because one address is one rental. 4-unit property is one rental. Again, 2 rentals equal 1 sold flip, so we can work on that tier system. What do you think your credit score might be? Okay, and the property type, single family, multifamily, condo. You want to ask those upfront questions to kind of get an idea of the borrower's experience and a little bit about the property. Then most important, purchase price, repair budget. What do you think the ARV is going to be? And that from the left side is going to tell you, when you hit calculate, it's going to tell you, based upon what you've told us, we can go up to this amount on the purchase price. Let's say 85% financing on the purchase, up to 100% of the repair cost. If it does tier downward, it could be based upon experience, or we have that ARV cap. We never exceed above 75%. So, depending upon what the borrower has told you, if you put in 75 and it spits out 65, maybe it's a quick call just to review what the after repair value might be. And it gives you a chance to kind of review everything with the borrower, make sure that the information you received is what the information they have on paper. And then the rental loan. So we kind of talked about it. I try not to send out graph charts and say, okay, it's up to you to determine, put your fingers together and where do you think it meets. Oh, and don't forget to add your adjustments, right? We give all that information to you because knowledge is power. So you're going to find out, hey, how many rental properties do you own? What's your credit score? And what type of transaction, purchase or refi? If it's a refinance, do you want to just take out the existing loan amount and put into long-term financing? Meaning like, hey, are you coming out of a bridge loan? And that gives you an opportunity to talk about a bridge loan product with them to do more deals. So if they are going to refinance out of a bridge, straight rate and term, you're going to put transaction type, rate and term. If they're telling you, hey, I want to take out my cash out, I want to buy more properties, that's going to be a cash out. Type of property, single family, multifamily, condo, townhome. Okay, if it's a purchase, is it a purchase price? So big thing up front, what is our minimum purchase price requirements? And then what's the minimum market value for a refinance? Purchase price, try to keep it at 100,000 for a single family. On a refinance, try to keep the value 110 to 115 if we can. We do have the ability. So our net loan amounts are going to be about 75,000 net. We do have the ability to go a little bit lower. We try not to at all, every deal, but we do have that ability to help you guys out to go to about 70,000 net loan. And then you're just going to get some basic information about the property. What are you bringing in on rents? What are the taxes? What are the insurance? If you don't, if you think that I'm intruding, it's a little bit more than I want to, just try to get a rough idea. I can just tell you that if you ask about what do you think this is going to rent for, I can go online to find a tax roll that I can get that information. And I'm going to probably put a monthly rent based upon what I think the value is going to be, about $1,000 to $2,000. You really don't see insurance costs going over $2,000 unless the property is in a flood zone, which we can look at an aerial map to kind of determine that for you to help you guys out. And then lastly, it's just going to ask some information. We don't really care so much if they're self-employed. We do want to kind of know if they do own a primary residence. So we look at that experience base. So for the rental properties, we are going to require that the person owns a primary residence and that they also maybe own one additional rental property. Why is that important? Because the first rental We don't want them living in it because we can get in trouble. So we do want them to own a primary plus one rental. If they do not own a primary and they rent, we'll still do a deal. They have to own at least 2 rental properties, maybe 3 rental properties if it's a refinance, the subject being included. But I'll go over that with you guys if you have any questions. Now, what are your responsibilities, right? What do you have to do? Well, not too much, right? Put an application in. It's pretty simple. Document upload. If you don't like the upload portal, you're having trouble with it, I don't take offense. You can email it to me. I can do it very quickly. I try to help you guys out as much as possible as a partnership. I'm not going to tell you, well, you got to do it yourself. Like, that's not how I operate. I treat the deal as a deal. We're grateful for everything that you guys present to us and want us to work on for you. So I'll be more than happy. You can email me if I'm not available. I'll answer my emails almost constantly, even on the weekends if you have questions. Obtain and provide contact information. That's pretty important for us. We want to have an accurate telephone number, not that we're going to call the person, but that is, if somebody needs to post-closing contact the person, we have an accurate contact number for them, and then an accurate email address. Okay, that's really important. We also need, like, if it's for an appraiser, for an appraisal process, want to know who the key contact person is going to be for the appraiser to call. Title company information. We do not select title. Unless it's a state of New York, which is a different story altogether. We allow the borrower to select title. If they come to you and they say, I don't care, this whomever, okay, we'll choose a nationwide company. But we want them to have the utmost confidence that they can price shop to find a very competitive title rate. And then, of course, their insurance agent, because we do require an HOI policy on the property. The loan processor will go over that policy with you. I also can give you some information if you need to know about the mortgagee clause. That's always available to you. The loan processor is going to give you like a one-page doc that you can share with the agent so you guys know, like, there's no guessing. We kind of tell you verbatim, this is what you need to help you. Interface is leaded, of course, anytime basically you want to reach out to me on the deal, you can either tag in a note, email, or contact me directly. I try to be as most available as possible. Phone sometimes could be kind of troublesome because a lot of people are calling in or I'm answering a lot of questions. If I'm on the phone, shoot me an email. Hey, I tried to call you, but I have a quick question. If I'm on the phone with my headset, I will write right back to you. I'm good at multitasking. And then lastly, LendingOne does the rest. We get you guys to closing. Well, it seems like a lot. What's the file process like? I can tell you, it's not as complex as it looks. So how does it go? Well, you complete an app, right? Many times you're just going to complete the app. And I'm going to give you a call and say, hey, Anthony, thanks so much for your application. I have a couple quick questions for you. And I'm going to go over it with you. And if the application is completed in full, I'll call you up and say, I'm going to send you a quote. But before I do that, how many points would you like? Or did you want to do any YSP if it's a rental? Or, hey, this is what I'm looking at. Or sometimes you'll put an app and say, hey, I just wanted a quote and I got confused, but I put an app in. Okay, no problem. I'll give you the quote over the phone or I'll send it to you in writing. I review the files and the terms with you. I'll provide you a real-time quote, same day, within minutes. If it's a completed app, it goes automatically from my system. Let's just say we've got the file in, we got all the docs in, I review the file with you, I send you a quote, borrower agrees to it, we send it off to underwriting. A term sheet is usually going to be given back to you, a formalized term sheet with conditions by our underwriter within 48 hours. Many times, if it's a repeat client, it can be within 24 hours, but on the first go around, it's about 48 hours for a bridge loan and about maybe 72 hours on a rental because there's a little bit more review process. I would tell your borrowers that once they've done one deal with us, it's a very step and repeat process. Many of the docs are kept over and there's a few intertwining parts like a new sales contract and repair budget if it's a bridge loan, or a new purchase agreement if it's a rental purchase, or if it's a refinance of a rental property. Hey, we're going to need a copy of the lease. That's really about it. Maybe, depending upon the time frame, an updated bank statement. Going back, you get the term sheet. You send it off to your client. They can either e-sign it or they agree to it. You just write back, hey, they agreed to it. Ideally, we'd like to take the appraisal payment the same time that we submit it to underwriting. And the reason being is that right now, because of the timeframes, there's a little bit of a lag and delay with your appraisers, depending upon what region in the US. Many are taking 7-10 days. So as soon as we get the file submitted to underwriting, that appraisal's been paid for, we can place it for bid on day one. We don't have to wait a few days until the term sheet because we've already reviewed the file and given you a quote. I do a pre-underwriting myself. So I try to give you the most accurate, update information. If I tell you, hey, this might be an issue, I might need these docs, I don't want to push the file yet. And that's because I don't want to delay the file to get it suspended or there's more questions before we can get a term sheet and we waste time. We try to get everything up front. So when that file is submitted to underwriting, it's a smooth process. But we like to get the appraisal payment before we just submit the file to underwriting. Key note on the appraisal payment, we're not going to place it out for bid until it's submitted to underwriting. We used to do that in the past, but on the 11th hour, a lot of like, hey, I'll get you docs. And when those docs came in, there was gap funding issues or there are other issues, and there was the big delay or the file couldn't get qualified and everybody's out money. We try not to do that. So what we have done now is kind of treat it like once the file is complete, the appraisal payment's made, it's submitted to underwriting, and we get the ball rolling with everything. Closing preparations, that's kind of verbatim what we just went over with the loan processor. Of course, they contact title and the insurance company. Key thing, you know, I get a lot of phone calls. Hey, lender X did this loan with us. The appraisal payment, the appraisal came in and you got, you know, they can't do the file or, you know, it came in ultra low. What can you guys do? Can you accept the report? Things of that nature. So let's just say you have, you know, we do an appraisal, it comes in a little low. What's our process? Well, internally, we review all appraisals to make sure that they're accurate and they're completed. Once that file has been approved, let's just say like once that appraisal has been approved and we give it back to you and it's a little bit below value, you do have the ability to do a rebuttal. I will send you a form. That rebuttal is reviewed internally by a third party. They'll do a write-up and they'll say, borrower, the reason why these comps make sense is A, B, and C, or the reason why they do not make sense may be A, B, and C. But we just don't tell you, hey, you know, it's a science and not an art, and we can't help you. We give you understanding so you have the most confidence for the explanation, but the borrower also understands maybe why things are appraising or not appraising to that value. And then, you know, hopefully the deal makes sense and we can all, you know, go on with it. Once you give clear conditions, the file is then given a clear to close, and then, you know, we communicate with title and we settle. Now on a rental, it takes a little bit longer. Why is there a discrepancy between timeframes on a bridge and a rental? Well, once that rental has been, the appraisal has been received and all conditions have been cleared, we then send the file for a secondary review, and it's called a pre-qual. That's a secondary review. Basically, they're going to double check everything and say, okay, this file is complete and we can move on with it. It's a 30-year note, so we have to have another set of eyes. It's not a quick turn, but we have to make sure everything is done up front. So post-closing, we're not coming back for other issues. That's a 72-hour process, 3-day process, hopefully sooner, but that's why there's a little bit longer than delay. And then lastly, how do you get paid? Where do I get paid? Well, you get paid. So once on the HUD, you're going to see a line itemization as a total lender's fee payable to LendingOne. So the client's not going to really know what your cut is, but that gross fee is shown on the HUD. Once we receive a setup servicing, meaning that like, hey, funds have been received and, you know, we have all the funds, we will wire you direct your commission. I review your commission before closing to make sure that terms are confirmed so there's no surprise like, hey, you shortchanged me or I got paid too much. I'll review everything with you prior to, but you'll get paid via a wire. So I will need wiring instructions, you know, prior to closing for you. And then, you know, it's a step and repeat process. The more deals that we do, the easier the process is. And, you know, looking forward to helping you. So the LendingOne broker support, what does that entitle? Well, you have a dedicated account executive, such as myself, that you can expedite files, run scenarios, and you get to communicate statuses directly from our portal through the loan processor. We have a dedicated processor and a closer that will maintain status updates, also conditions, and speak directly to the title company. Portal status updates, you can have a real-time internal note system that if the loan processor needs to reach out, they can. You can also reach out to the loan processor or myself at any given time through the portal. And it's an ingoing and outgoing message system. Protection, we do protect our brokers. The borrower will register in the portal and they will not be allowed to go around you. So they'll have that email address and that contact number that will trigger our system that Mr. Smith has an application, you'll get notification to your portal as well. There's no incentive for the borrower because you're deeply discounted lender fees. We will always advise a borrower to reconnect with you. So if they do happen to use an alternative email address, we will catch that and contact you and inform the borrower to reach out to you directly. And lastly, we let you know so you can follow with them in a timely manner. Most importantly now, your compensation. How are you paid? Well, you are paid at closing. We will wire funds directly to you once the file is set up for servicing. Now on the HUD, the figures will be shown as cumulative between our fees and your fees. So the borrower will not know that you're making 1, 2, or 3 points. It will just show us one lump sum. How much can you make? Well, starting from left to right on the fix and flip, if the person has done 7+ flips, we will take 1 point or $1,500, whichever is higher, and you can go up to 3 points on the HUD. If the person has under 7 flips in a 2-year period, we will take 1.25 points, allowing you up to 2.75. Doc and processing fee is $7.95. We do not allow a substantial or an additional processing fee on the HUD. There's one processing fee, which is shown by LendingOne. On the rental, again, it's 1 point or $1,500, whichever is higher, and we allow up to 3 points on the HUD for yourself. Doc and processing fee is $9.95. And then for new construction, we have a flat 1.25 point with you making up to 2.75%. The doc and the processing fee is $7.95. Again, that's wired at closing.
So on the rental, is there a yield spread premium available to the broker community?
There is thank you, Michael. There is a yield spread available. How is that paid? Well, for an additional 0.5 point to the interest rate, we allow 1 full point paid to the broker post-closing. We also have the ability to do a rate buy down. So for an additional points on our commission, we will allow up to 1 full point of a buy down with the floor rate being 5%.
And then on the multifamily bridge program, we charge 1 point origination fee. Typically, the broker also charges 1 point. And on the portfolio, it's the same scenario with the exception that there is yield spread available on that for that program as well.
Lastly, we wanted to touch base with you guys on business development sources. So how can you go about getting some clients? Well, of course, investors, real estate agents who are local to your market, wholesalers or bird dog watchers, financial planners, builders for new construction, title or closing attorneys, investor groups, some local meetups, and also some Facebook groups as well, online networking groups, and then online marketing. We also are going to start launching an email campaign with templates available for brokers, which should be out very soon. So we are assisting and helping with a digital marketing platform for you guys as well.
That's great, guys. Unfortunately, we're at the end of the hour.
Oh.
Very informative. Thank you both, Michael and Mark. You know what? Before it turns off, I'm going to try to throw in 2 questions real quick. But everybody, we will definitely send out all the information on how to contact Michael and Mark. We'll give you out their contact information as well as the video itself that will be sent out to everybody. And within 2 days, hopefully. It's an edited copy of it. But guys, let me ask you a real quickie before we do get turned off here. Do you guys lend out to foreign nationals?
That's a great question, Anthony. So right now, pre-COVID, we did, but post-COVID, not yet. So
Okay.
That's hopefully something in the future, but we do ask, if they're a green card holder, the answer is yes, they are a resident. If they have a visa, it might be tricky. But if they're a Canadian borrower looking to invest in the US, maybe, maybe not. But if anybody else from like Europe or we get a lot of Europeans, Middle Easterners who are looking to invest in the US. That's right now, that's going to be difficult for us.
Okay, great. And just as a broker, do I need to be licensed to be working with you?
Great
Generally,
question. Mike, you want to
generally,
take?
yes. There are individual states that have licensing requirements. We're not attorneys. We suggest that you consult with either your local state licensing requirements, or contact your attorney just to verify if you need one or if you don't need one. But we can't provide legal advice. The vast majority of states do require, on the residential side, if not all, to have licensing requirements. It's different on the commercial side, but again, you should consult your state licensing board or your attorney for that advice.
Great. Michael, can you give us a little idea, since you guys do have a 3-part series, can you give us a little idea what you will be talking about possibly in March?
We're going to arrange for our COO to have a broad overview of our program and also some market insight. We anticipate that we will have that available at the end of March. That will be our next webinar feature.
That's great, Michael. Michael, Mark, really thank you. This was great. Really a lot of stuff here and very exciting. And again, once again, there are some of you, of course, that were not able to register to check out this webinar, but we will be sending out all the contact information, including the video, for anybody that needs to continue asking questions. And once again, I want to thank you all for coming on board and registering today for LendingOne's webinar. Thank you. Thank you, everybody.
Thank you, guys.
Thanks, guys.
Thank you.
Yeah, thanks, guys. Take care. Everybody be well. Bye-bye.
Bye-bye.